Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at GE Vernova.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis of GE Vernova. We have some really strong recent data points that point to a pretty significant shift in their financial trajectory.
Okay, let's start there then. Set the stage with the big numbers from Q3 2025. The company delivered, approximately $10 billion in revenue.
That's right, $10 billion, and that's up 12%, 10% if you look at it organically.
For a heavy industrial company, that is serious top-line momentum.
It is, and what's really fascinating is how that's translating to profitability. They hit a net income of about $500 million.
Yeah.
But the number we're really watching is the adjusted EBITDA. That came in around $0.8 billion, which gives them an 8.1% margin. It confirms that the margin expansion story we've been waiting for, it's happening.
And you can see exactly where that's coming from when you break down the segments. Power, for instance, was $4.8 billion in revenue.
Up 15%, yeah. And this is the consistent engine of the company. They delivered 20 heavy-duty units, including 13 of their flagship HA turbines.
And those HA turbines are key, right? They're sort of the bridge power technology that grids need.
Exactly. And the margins there were strong, 13.3% segment EBITDA margin. That's up 140 basis points.
Solid improvement. But if power is the engine, then electrification has to be the accelerator. The growth there was massive.
Oh, absolutely. Revenue was $2.6 billion, up 35%. You almost never see that kind of growth in this sector.
And the profitability jump in electrification is even more eye-popping.
It really is. The segment EBITDA margin just jumped 470 basis points to 15.1%. That's being led by grid solutions, HVDC, and battery storage.
Okay, so this is where we have to pivot to the elephant in the room, the wind segment. It's still losing money. It posted a negative 2.3% EBITDA margin in the third quarter.
It did. And that's been the historical headwind, the main point for anyone bearish on the stock. But you have to look at the context here.
Yeah, okay.
That negative 2.3%, while it's a loss, it represents a massive improvement. We're talking 870 basis points better than the prior period.
That is a huge swing. So it's not so much a drag anymore as it is stabilized.
It's moving from a significant drag towards stabilization. Exactly. Now, management did say they expect about $400 million in win losses for the full year 2025, which is a little worse than they thought. But the key here is the timeline. They expect those legacy offshore issues to completely roll off by 2028.
So wind eventually stops being a drain and could actually become a positive contributor.
That's the plan. And the stabilization is what's really unlocking this huge upgrade to their long-term outlook. This is the story that's getting institutional investors interested.
Okay, so let's get into that. The multi-year outlook. This is where the story gets really interesting. What are the new targets for 2028?
Well, the revenue target alone is pretty staggering. Management is now expecting 2028 revenue of approximately $52 billion.
$52 billion. That's up from a prior target of $45 billion. That's a huge jump.
It is. But the profitability leap is even more dramatic.
Okay.
They are now guiding for an adjusted EBITDA margin of about 20% by 2028.
20%, up from a prior target of 14%.
Sure.
So from where they are now, that implies over 1,100 basis points of margin expansion?
Over 1,150, yeah. It's a transformative target.
And all of that has to have a massive impact on cash flow.
It does. This structural shift means they now expect at least $22 billion of cumulative free cash flow between 2025 and 2028.
$22 billion. That's a huge increase from the previous expectation of $14 billion.
It's a monumental increase, and it means they have more than enough internal funding. That FCF profile, they're looking at $3.5 to $4 billion in 2025, then $4.5 to $5 billion in 2026.
So what does all this cash mean for shareholders, for someone listening who owns the stock?
Well, they've been very clear. They plan to return at least 1/3 of that cash generation to shareholders.
And we've already seen them act on that.
We have. The quarterly dividend has been doubled to 50 cents per share, and they've also increased their share repurchase authorization. So it's not just talk.
Let's get into the competitive moat here. What makes GE Vernova so uniquely positioned to capture all this growth from, electrification and decarbonization?
It all comes down to the backlog. That's their competitive moat. They have a $135 billion total backlog right now, and that is expected to grow to nearly $200 billion by 2028.
Wow. That gives them incredible revenue visibility for years to come.
It does. And pricing power. Just look at gas power. Their huge installed base creates this recurring high-margin service revenue that competitors just can't replicate.
And they have that target of 80 gigawatts of slot reservations and backlog by year end, which basically locks in future revenue.
Exactly. And on the electrification side, you have these really high barriers to entry in areas like HVDC and complex grid equipment. Customers don't switch suppliers easily.
Right. The switching costs are too high for critical infrastructure.
And don't forget that service annuity. That massive installed base just keeps generating cash.
Plus, you have these huge macro factors pushing everything forward. The demand for data center power is just exploding.
That's a huge one. Companies like NextEra are trying to build 15 gigawatts of generation just for data centers by 2035.
And that requires exactly the kind of gas turbines, storage, and HVDC equipment that GE Vernova makes.
It's a perfect storm of demand directly in their sweet spot.
So beyond the fundamentals, how is the market reacting to this? Is the stock actually showing strength?
Oh, it's showing significant technical strength. Recent data suggests it's been outperforming the S&P 500, even outperforming NVIDIA and Bitcoin in some periods.
That's impressive. And it's not just retail traders, right? We're seeing big institutions moving in.
Definitely. This is supported by institutional accumulation. Large firms like Eventide, Adage Capital, Vanguard, State Street, they've all been increasing their positions.
So we're talking hundreds of millions of dollars in bullish conviction.
That's right. And while you see a few firms trimming their positions, like AQR or Electron Capital, the stock often remains a top holding for them.
So it looks more like portfolio rebalancing or maybe some profit taking, not a change in the fundamental thesis.
I think that's a fair way to look at it.
Okay, so for our listeners, what are the immediate things to watch for? What are the near-term catalysts?
The next big event is the Q4 and full year 2025 earnings report. The market is going to be laser focused on a few things.
Let me guess. Revenue, cash flow, and 2026 guidance.
Exactly. They need to see revenue hit the high end of that $36 to $37 billion range. They need to see delivery of that $3.5 to $4 billion in FCF.
And the 2026 guidance has to be solid.
It has to reinforce the path forward. Revenue in the 41 to 42 billion range, and that adjusted EBITDA margin ramping up to 11 to 13%.
Are there any other, maybe more speculative upsides we should be aware of?
Yes, I think so. There's always the potential for a surprise announcement of a large-scale contract with a hyperscale data center operator. That could be a huge catalyst.
Right, given the power demands we just talked about.
And management has also left the door open for some targeted M&A, maybe in grid or storage technologies, which could be an incremental upside.
Now, we have to talk about the non-wind risks. What could derail this story?
Well, cyclicality is always a concern. Bookings in gas power, especially, are exposed to macro cycles and the timing of utility spending.
Which can create some lumpiness in the orders from quarter to quarter.
For sure. And we saw a bit of that earlier this year when Q2 earnings reportedly missed expectations, even though revenue is actually ahead. It's just a reminder that the timing of these huge contracts can cause short-term volatility.
Okay, so let's bring it all together. The investment thesis here seems pretty strong.
It is.
Yeah.
You have a pure play leader in electrification, a massive and growing backlog. The wind operations are finally improving.
And a clear path to basically double the EBITDA margin by 2028, which should generate a tremendous amount of free cash flow.
It really has the profile of a multi-year compounder. I think the key will be holding through any of that short-term volatility to really capture that 2025 to 2028 margin expansion story.
It truly looks like a compelling long-term play. If you want to keep track of these long-term plays and the specific catalysts that matter, make sure you subscribe to Smart Wealth with Joshua for our daily analysis. We'll definitely be watching those Q4 numbers very closely.